Before the presentation, I would like to preface that all information and images were pulled directly from the SEC's page, and some images were pulled straight from Google. Hello, my name is Ryan Walt, and this is my accounting project. Today, I have chosen to present information on the public company Neiman Marcus. Why, you may ask? Because when given the opportunity to sift through the financial statements of any public company, why not do one facing bankruptcy? And as a man of business, I had to see for myself outside my research. What is Neiman Marcus? The company Neiman Marcus was founded over 100 years ago and is still one of the largest luxury fashion retailers in the world. On top of that, assisting in their high valuation as a company, they had approximately $4.9 billion in revenue in the fiscal year 2018. I don't know about you, but that's a lot more than I made in 2018. Their company starts off as business to business as they purchase goods from worldwide fashion brands. From there, they are shipped to one of their 3 distribution centers, and with their amazing inventory management, they are able to filter goods and which exact stores need them based on inventory levels and what is selling there to ensure high profits. A lot of goods sell, but the ones that don't are sent to last call, which is basically post-season goods that are marked down in price, which is much better management of inventory than just consider it an immediate loss. The inventory sold consists of everything from apparel to home furnishings and decor. General inventory is listed here on the consolidated balance sheet. On the consolidated balance sheet, inventory is presented as a current asset along with inventory merchandise being listed as an expense and cost of goods sold. We briefly touched on these tables in class where inventory values are stated at the lower of cost or market, which I can proudly say I can figure out thanks to this class. Thanks, professors. Now moving into their accounting policies, they had 2 that were made very clear in their systems. For starters, they use the retail inventory method of accounting, where the valuation of inventories at the cost and the gross margins are determined by applying the calculated cost to retail ratio for various groupings of similar items to the retail value of their inventories. They also use the asset and liability method of accounting for income taxes. Under this method, deferred tax assets and liabilities are determined based on the differences between the financial reporting and the tax bases of assets and liabilities and are measured using the enacted tax rates and laws that will be in effect when the differences are expected to reverse. They are routinely under audit by federal, state, or local authorities in the area of income taxes. Considering the company is so large, they have a lot of inventory to manage. A part of managing it well is having strong internal controls. The controls they mention in the management section of the statements start in item 9A, titled Controls and Procedures. Chief Executive and Chief Financial Officers deem their controls effective and said they provided reasonable assurance that the information in reports was recorded, accumulated, processed, summarized, reported, communicated on a timely basis, and within the periods in the SEC's rules and forms. Next up in item 9B, management conducted evaluations of effectiveness of the internal controls or financial reporting based on the framework and criteria established in the Internal Control Integrated Framework, issued by the Committee of Sponsoring Organizations of the Treadway Commission. From that evaluation they conducted, they were effective and management did not identify a single material weakness. And while I couldn't find a table showing adjusting entries, this table does show that they count and know what they have. The system of internal controls maintained provided management with reasonable assurance that the transactions are recorded and executed in accordance with its authorizations, assets are properly safeguarded and accounted for, and the records are maintained as so to permit preparation of financial statements in accordance with GAAP, which we mentioned in class is the generally accepted accounting principles which all publicly traded companies are required to follow. Although it faces bankruptcy, the company still runs their accountings as they should, and internal controls tight, consistently, and clearly list inventory and had proper accounting procedures. I had a great time at Neiman Marcus and an even better time in their SEC filings. I hope to come back again, and maybe this time I'll come back with my CPA. Thanks for watching.